macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Who's afraid of new highs? I'm certainly not, and I'll show you my latest trade in a moment. Right now, I want to show you some more interesting things that have stood out this week to me. First of all, let's just take a look at the spiders, the S&P 500. I'm showing you a 2-year chart here, roughly, so you can get an idea. I want you to focus on the 50 and 200-day moving averages. Blue is the 50, red is the 200. Nice trend here, right? But what you notice is they keep getting farther and farther apart. Let's zero in on this gap between the 50 and 200-day moving average on the SPY. Here's a chart which tracks the spread. Since 1994, how far apart have the 50 and 200-day moving averages gotten on the SPY? Over here, what are we looking at? Here's the zero line right here, okay? Here's $6, a $6 spread between the 50 and 200-day moving averages. When have we been there before? Well, during the tech bubble, 1999, and we've been there early 2009, which makes sense if you think about it. When the market rapidly recovered, the 50-day moving average was able to quickly launch up, and as the 200-day moving average lagged. Let's look at a couple more examples. Into 2010, same kind of deal as 2009. Here's the 2011 sell-off. 50-day moving average crosses below the 200. Everybody looking for the golden death cross there, the bearish cross. Didn't prove to take out the market. But where are we now? We're back up here at 12. This is $12. I noted this is the $6 level here. These are in $6 increments. So way up here, in 2009, 2010, we crossed the $12 mark as a spread between the 50 and 200-day moving averages on the SPY. Here we are again. This chart is from Michael Harris, guy I talked about last week, and he's just pointing out that this could be some resistance. While there is no natural resistance for the S&P at, say the level of 1700, because we've closed many times above the May highs, so there's no previous levels of supply to speak of in terms of technical resistance. There's just the big round 1700 number, which is psychological. So the market is stalling, congesting here, waiting to go higher, as I like to say. But this could be a natural piece of price resistance as the 50 and 200-day get that far away from each other. All right, a couple more charts. Let's look at U.S. New highs minus new lows. And where are we now? Well, after the bounce, off the June lows into July, new highs came back strong, exceeding new lows. And this is an end-of-day shot from yesterday. And it's just, for the total U.S. stock market, it's new highs minus new lows on a daily basis. I think this thing still looks in pretty good shape. The one thing I wanted to point out to you is look at this volatility here in 2013, where new highs and new lows just keep whipping back and forth. This is where your Hindenburg omen comes from. It somehow measures that high-low sort of disparity where it whips back and forth. Anyway, that's where that comes from. All right, let's look at the summation index. Looking good here. Remember, we looked at this in June as a buying opportunity. Remember, this is the McClellan oscillator, but it's cumulative. So, it gives you an even more smoothed out measure of institutional advanced decline statistics. And this thing's still looking good here. I think if we hold the 400 level, we're off to new highs in this market. All right, now let's look at the triple Qs. Breakout here that I'm buying. Yesterday, our group went long a triple levered version of the Qs, and on this breakout here. Now, as a technical trader and a timing trader, a couple different trades I like. I like to have an edge in a trade, so I want to buy dips if I'm trying to get long. Will I buy breakouts on strength? Yes. I'm cautious about doing that, but here was a play with the Qs that I thought, that I think is going to work. And what's driving it? Well, the NASDAQ 100 is 57% technology, as we all know, so we call it the tech index, but it's also 20% consumer discretionary. What's working? Well, some of the stocks in our other portfolios, I've got Coors making new highs this morning. Conn's, the big box retailer out of Texas that's going to grow all over the United States, that's making new highs. SodaStream just pops up huge this morning on an earnings beat. QCore launched from 52 up to 65 this morning, on their numbers. And another retailer, Ulta, pushing through 100. So maybe the consumer discretionary is only 20% of the Qs, but it also drives technology, because if you think about who needs technology more, it's retailers. And I threw QCore in there just for fun. Brian Boland's a big fan. A little shout out to him for staying with that one drug wonder and just incredible returns there. Now let's look at where the Qs are going to run into trouble, and I'm buying right into this resistance. This is a long-term chart. Remember, recall the high in 2000. What was the high in the NASDAQ composite? Not just the NASDAQ 100, but the whole thing. So now the symbol is CompQ. That was just over 5,100. 5,162 was the all-time high there. I thought it was higher, but in any case, let's throw some Fibonacci retracements on here. We go all the way down in 2002 to a level of 1109 on the CompQ. And you throw your Fibonacci retracements on there. It was just last year that we got through the 38% retracement, and then decisively through the 50% retracement at 31.35 this year. Now look what we're bumping up against. The 618, the 62% retracement is at 36.14. That could prove to be some resistance here. I still like the position because I think that the S&P is going to get through 1,700, regardless, of what the Fed does. We had strong GDP and revisions this morning, and the momentum is here. So I'm buying the momentum. Obviously, a lot of other players are too. If you look at some of the stocks making new highs this morning, and I think everybody's got one eye on the exit door. But if you're sitting on the sidelines in cash, you're missing out. We're going to be drawing those folks in. All right, just a quick look at a few charts that came on my radar. Don't follow me in the Q trade if you're afraid of heights. I'm not afraid of new heights, and we'll see what happens. Check back in this trade a week later. Still short the Russell with TZA as a sort of relative value trade and a small hedge. And we'll take a look at that one next week too. All right, thanks for joining me in the kitchen.